All right. Well, it looks like we have everyone logging on and we have our presenters. And yeah, let's go ahead and get started. Hello, everyone, and welcome to our webinar today, where we'll be exploring the state of unicorns and the VCs that fund them across Europe and the US, and some key takeaways from our upcoming Relationship Intelligence Report, US versus Europe edition. I'm Dan Palanca, Senior Product Marketing Manager with Affinity, and I'm excited to be joined by Daniela Rafael, VP with Dawn Capital, and Brian Cashin, Senior Associate with Team Worthy Ventures. Thank you both for joining today. Daniela, as I mentioned, is a VP at Dawn Capital, the largest B2B focused fund in Europe. Prior to Dawn, Daniela worked in growth at London-based fintech Capital on Tap and all over the place at McKinsey. Danielle, good afternoon.
Great to be here. Thanks for having me.
Thank you. Thank you very much. And then Brian is a senior associate at Team Worthy Ventures. Previously, he worked as a software engineer on the Yale ITS technology and development team. Brian joined Team Worthy Ventures full-time in 2019 in Manhattan after graduating from Yale College with a bachelor's in economics, and he is an accomplished violinist. Brian, good morning. Great to have you.
Superb to be here. Looking forward to the conversation.
Great, great. All right, so let's go ahead and we'll jump right in. So obviously, what we want to talk about today is some of the trends that we have seen in unicorns over the past several years. So jumping right in right away, looking at 2021, it was definitely a stellar year for unicorns. We actually saw over twice as many unicorns minted than the previous year, and they received about 338 billion in global funding. So just to sort of set a baseline, Daniela, love to hear from you. How would you define a unicorn, and are they all created equally?
That's a great question. I mean, look, 2.5 more unicorns created last year. I think you have to compare the baseline and question whether they really are the same if you're looking at unicorns made in 2020, 2019. And I would suggest that there is a mix of unicorns that was minted in the last year. I guess you could say there are the true unicorns, those that have product market fit. They've got the sales to back up their valuation. They've got great teams. They've built out a super management team. And, there are public comps in the market that suggest that, the $1 billion valuation is, justified. And then I think you've got unicorns that are sort of an output of the excitement, I guess you could call it, of 2021, that kind of raised because VCs saw a lot of potential in a company, and in order to get into that potential and be a part of the journey, they invested at ever increasing valuations, and that has resulted in a unicorn that is a unicorn in perhaps valuation but not necessarily in nature. And I would imagine that we'll see some unicorns still get minted this year, but they're probably going to be more of the true unicorn variety rather than the, I guess, potential unicorn variety.
Yeah, I think that's a great point. I think with what the market's looking at today, definitely looking for more authenticity than just hyper growth. Brian, from your perspective, do you have any thoughts on what factors might have led to this growth globally, in 2021, and specifically you're from the US? Do you have any thoughts on, the growth in your region?
Certainly, I agree with what Daniela has said, and I'm astounded, even just having spent 3 years now in the venture industry, how many software platforms have been focused on allowing startups to communicate best with investors, allowing startups to communicate best with prospects, and so grow their team, achieve the valuation multiples they're searching for by having the right conversations at the right time. And as Daniela had alluded to, also the valuations you were seeing in 2021 created a lot of upward pressure on the valuations in the private market. I think you're seeing the opposite of that right now. And so to the extent in 2021, there were investors that were willing to really give atmospheric multiples of revenue. Now in the current situation, you see valuation multiples have returned back to where they were in 2019, but not all the way back to where they were 5 years ago. And in that sense, you saw a lot of unicorns being created by having investors looking to the public markets and valuing their companies in the private markets in comparison. And now you're probably going to see quite a bit less, just given that there's a different valuation environment in both markets.
Great. Yeah. And diving into that a little bit further in both of these markets. So, in 2021, what we sort of saw was the US having a total of around 509 unicorns, Europe having a smaller figure of around 132. But that they have, Europe has seen some pretty strong growth in terms of the rate at which unicorns were being produced. So, Daniela, from your perspective, why has Europe been gaining ground against the US in terms of the rate at which they're creating unicorns? And would you say that Europe has sort of hit a critical mass with everything going on with 2022, or is there room for continued growth?
Yeah, I mean, I guess if you think about what makes a unicorn, a large part of that is having a stellar founding team, being able to recruit and hire excellent team members going forward, and having the funding to get there. I think everyone's aware of the PayPal mafia, and that bred thousands of startups of people who'd been there, done that, found exciting problems to solve, and kind of come out with the connections. Be that VC, be that to hire their own great team to go and build something. And I think we're finally starting to see a lot more of that pick up in Europe. So there was a recent funding round, I think, with a company called Tesseract, ex-Revolut, very early employee, hugely popular round fairly early on. So I think we're starting to see a lot more of that. And also, as I guess companies within Europe mature, you just have more and more people observing. I have a bias towards B2B because that's what we do. But you have more and more people observing growing pains as a business goes. And so they see that, they have their connections, they have their abilities, and they can kind of, spin out and scale their own solution to a problem that they see. So I think on the team side and the talent side, certainly kind of Europe is definitely trending upwards, and on the funding side as well, big evaluations need bigger funds. And so, European funds have been, growing and growing. I think, there's a recent early stage fund that just raised $1 billion fund, which is hugely exciting. And I guess we've also been having US funds, finally seeing that Silicon Valley is not the be all and end all, and pouring money into our side of the pond. So, all that leads to, growing unicorns.
Great. You also briefly referenced B2B. Do you have thoughts on how B2B is evolving right now versus B2C in sort of this more uncertain market?
I mean, I really don't have much exposure to B2C, so I really couldn't say. But what I can say is that B2B, there are always going to be concrete problems that businesses need to solve. And there is, I think we like to look at things, is a software revenue generative, or is a software cost cutting, and what is most important to a business at this time. And so in periods of downturn, you might find that people are much more likely to spend money on kind of hard ROI, which means cost cutting, rather than spending money on, I guess, potential ROI, which would be on the revenue generator side. So we see a bit more of that, but I think part of the reason why we like B2B is because there's always business problems to be solved.
Absolutely. And then Brian, from your perspective, I'm not sure if you're more focused on B2B or B2C. I'm not sure if you have thoughts on how those markets are evolving.
Yeah, absolutely. So I would say in this inflation environment, you absolutely see the disposable incomes of consumers being affected by the rise in inflation and interest rates. Obviously, if people are paying more on the interest rate of their loan and their money is worth less, they're going to have less money to buy a consumer product. Whereas some businesses are a bit cushioned from that because of a variety of the mechanisms by which it takes some time for inflation to seep into every aspect of the economy. And so I've just seen a lot of businesses that are either selling directly to consumers or selling directly to small and medium-sized businesses have seen the disposable income of their potential buyers decrease, and they've seen a downturn in some of their sales. And so they've encountered some growth issues and have been achieving lower levels of growth than they otherwise would have expected, having been at fairly successful levels in the 2021 period. So in general, I've seen the B2B environment, especially at the enterprise level, being a lot less infected by rising interest rates and inflation than the B2C environment, which has its potential buyers having their disposable incomes reduced by higher interest rates and higher inflation.
Great. Yeah, I think it'll be interesting to see how those sectors play out as we continue to see how the economy impacts consumers throughout the remainder of the year. Sort of taking a closer look again at the growth rate between the U.S. and Europe, we sort of saw a sort of a significantly faster rate of growth, as I mentioned before, in Europe than in the US. It was actually about a 39% difference in looking at growth rate of new unicorns in terms of percentage of new unicorns created by quarter. So Daniela, people often talk about how it's harder to scale in Europe, but does that same diversity of the ecosystem that we see in Europe that leads to this challenge also lead to diversity of thought and solutions that produce more unicorns?
I mean, I'd certainly like to think so. I think the nice thing about Europe, yes, it is harder to scale within Europe because, you're facing different languages. You need to hire salespeople who can, not only speak the language, but also speak the culture in terms of how to sell. You're facing different regulatory issues. You're facing different priorities, maybe in different countries. But I do think that, as you, I guess, bring people together who've had these, this diversity of experiences, they've seen different solutions. You can, I guess, create something that's a stronger, more interesting product. And over time, that would hopefully be reflected in, more and more unicorns coming. But I think, Europe has, I guess, hubs that bring people together and kind of, if you're talking about a fintech in London, you're not just talking about, the English experience. You're talking about, the German experience, the Spanish experience, the Italian experience will all come together in this kind of central hub and create, what we think are great companies.
Yeah, excellent, excellent. Brian, one thing that we are seeing right now, obviously, there's sort of been a staunch pullback in funding, as we get into the second half of the year. From your perspective, what is your outlook for funding in the US for the remainder of the year and even early 2023?
Well, I would certainly say no one has the crystal ball, and one joke is that if you have two venture investors in a room that have three opinions on this question, but the way in which I've heard people talk about it is it really depends on how some of the public markets perform over the coming, you could say, 6 to 12 months. And I've seen a lot of startups in the second half of the year go out and look for funding and be confident that their valuations will be reasonable, especially given that you've seen a number of investors delivering valuations much higher than you did in the early half of this year. I'd also say I think sometimes in terms of the geographic specific areas of the United States and the phases they're in. So I spent 11 weeks in Utah earlier this year, and they talk about Qualtrics being phase 1 Utah, Divian Podium being phase 2 Utah. Now you have phase 3 Utah. A lot of the reasons why you've seen a lot of localized startup success is because some of these founders then invest back into the industries from which they came. And I see a lot of ongoing enthusiasm for that localized funding trajectory for a lot of the companies. Even at this moment, I'm in Nashville, and you have successful Nashville entrepreneurs who might invest back in companies in Nashville. And so I think some of these trends have been less affected by the public market trends. So even to the extent there might be some downward pressure in valuations continuing in the public markets, you'll see a lot of the geographic specific trends of startup growth continue, and some unicorns arising from these localized funding networks.
It's interesting that you brought up the idea of localized funding. One of the things that we saw throughout our research was the idea that there's actually been a pretty significant shift in US dollars going to European markets. At this point in time, the year to date, the US represents about 42% of all unicorn investment in Europe for the year. So, sort of stepping away from the idea of local investment, what factors do you think are leading US dollars to move, across the pond? Do you think that US VCs are seeing more opportunity in the region, or, are European unicorns needing to look outside of their region for more capital?
I would note that the firm I work for, Teamworthy, made its first investment in Europe, Typeform, earlier this year. And one of the reasons was that there's so much more ability to find startups in the European ecosystem with so many of these sourcing platforms that I've seen arise, whether that be Dealroom or that be Grata or a number of the software companies that are providing search engines for discovering startups across continents. I've benefited a lot from using those tools. And I know for a fact that when I've talked to associates and VPs at other firms, they mention the proliferation of sourcing tools allowing investors in the United States to discover investment opportunities in Europe has certainly resulted in more investment in European startups by investors based here in the United States.
Excellent. And then Daniela, earlier you mentioned that Europe right now is raising larger funds. Do you have thoughts on where the sort of balance sits between U.S. funding into Europe, and is Europe looking to take some of that real estate back at this point in time?
Yeah, I mean, look, I think a lot of people always talk about the maturity of a startup ecosystem, but I think, it goes hand in hand with the maturity of a VC ecosystem as well. And, I think the European scene, I guess you could call it, is younger than the US scene. So I think, over time, a VC is also a company, right? So you need to prove your track record so that you can raise, more money from LPs. It's the same as, a startup trying to sell to a customer and upselling, right? So there's an element that over time you see these fund sizes increasing. And I think, eventually we'll get to the point where our funds are big enough to continue funding into the later stages. We have a super active early stage scene. But, I think Europe as a whole is working towards the growth stage scene. And then maybe at one point we'll see a, reversal of trends and we'll start fishing in the other side of the pond.
Absolutely. Yeah, it'll be interesting to see how that plays out as those funds get bigger. One area that we did look at with our upcoming report is the idea of how, market trends are operationally impacting VCs and specifically investors who are funding unicorns. So sort of looking at VC activity. Some of the things that we saw here were the idea that, VCs are definitely sending out more emails and taking more meetings in 2022. Daniela, would you say that's in line with your firm's trends? And if so, what's sort of driving this increased activity?
I mean, I like to think we always work hard. So we're always at the height of our activity. I mean, I guess that's an element, over the past, I think Brian mentioned this a bit earlier, founders aren't necessarily as open to the idea of funding round at the moment because of the compressed valuation. So maybe there's an element of having to be slightly more persuasive to get someone to speak to you that might point towards the email activity. From a meeting perspective, I think actually I'm having slightly fewer meetings, but that's because I'm replacing Zoom meetings with in-person meetings. And although they are infinitely less scalable because you need, half an hour between everything to move from one side of, a city to another, I think they are, especially as you progress through a process, supremely valuable. And I'd much rather, try and focus on having quality interactions than, back to back Zoom calls, as I, was unfortunate enough to experience early 2021 during the pandemic.
Absolutely. Brian, Daniela referenced that you need to be more persuasive right now to get meetings. Is that something that you're feeling, in terms of increased activity? Is that a big part of it? Or, are you getting more proactive outreach from founders right now as well?
I would absolutely note that there definitely has been a decline in proactive outreach from founders, and certainly an increased need. There always is the high need, as Daniela referenced, to be outbound sourcing investors. You want to discover the great opportunities where they are and build relationships with the people who can build the next billion-dollar companies. Those people are often not going to be reaching out to you in order to start the conversation. But I would say that it's certainly been the case that even when there are relationships I've had for a period of time that I'm reaching to check back in with founders, some of these founders are very hesitant to starting fundraising conversations even now, less so in this quarter than, let's say, in quarter 1 and 2 of this year. But because of that, there is this need to have an added degree of persuasion. If the company is an excellent company and has been capital efficient and has been responsible with the resources and the team members it has had, if you're interested as an investor in initiating a financing process for that company, to be creative on the structures you can use. If the company isn't going to go out for a financing round but decides they might be open to a post-money safe that you can agree on an evaluation for both sides, then that's something that I've seen return. I've also seen the return of the convertible note, which wasn't really prevalent at all back in 2021, and now people are talking again about having convertible notes with interest rates and a discount to the next round. And so I've seen more of a multiplicity of fundraising structures and certainly an added degree of persuasion necessary for starting financing rounds, because there is a hesitancy because of the perception, whether or not it's fully justified, on valuations being much less favorable to founders now versus 12 months ago.
Great. Daniela, you referenced that you're taking more in-person meetings right now. So obviously over COVID, we saw a big shift to virtual meetings, perhaps driving some of these increased activity numbers as you referenced. So from your perspective, it sounds like, do you see more value in an in-person meeting in getting around some of this hesitancy that Brian mentioned, or what is driving that shift to in-person for you right now?
I mean, look, there's a meeting for every occasion, right? it would be impossible to speak to every single founder in person. I'd never get anything done. But equally, if you've had the initial meeting over Zoom and there's something there and you're excited about it, quite frankly, if you're going to persuade someone who isn't keen on taking more money, then there's no better way than actually showing up and putting the effort in. I think the days of founders coming to you are long gone. We need to go find the founders and prove that we're as willing to work hard as they are. And so yeah, I think an in-person meeting for that, even if it means traveling across Europe to go do that, is worth it.
Great. Hopefully we continue to see the opportunity to get those in-persons in both regions. So, looking at opportunities, as you mentioned, sort of the US has sort of settled in a little bit, has seen an 8% decrease in new opportunities from Q2 2021 into Q2 of 2022, while Europe over this time period was continuing to grow their pipeline. But we are seeing in general at this portion of the year, as I mentioned earlier, sort of a pullback. Markets are settling into a drier outlook for opportunities right now. So Brian, from your perspective, what would you say savvy VCs are doing or can be doing right now to best set themselves up for success?
I would absolutely note that the principles that always ought to guide a thoughtful investor ought to still guide that thoughtful investor right now. You want to be able to build the relationships whether or not a company is raising a round. I reflect on Ben Graham's 1949, The Intelligent Investor, and he says you have to have a margin of safety. You have to be able to expect volatility and profit from it. And then you always have to have the knowledge of what type of investor you are. Know your motivations, know your temperament, know your timeline. And so I just reflect upon how the margin of safety principle is much more apparent now that you can access cost bases at a more, you would say, favorable level on the investor side. And so there's certainly no lack of enthusiasm of investors to start these conversations when it comes to how they present themselves to founders. You have to be able to do so by showing that the valuation has to always be secondary to the ability of that investor to accrete value to the company over a long period of time. And I've always reflected on how the founders I've met who are most thoughtful, of course, aren't starting the conversation by mentioning a valuation multiple. And in that same way, on the investor side right now, if you're able to continue to demonstrate that through customer introductions, strategic guidance, talent accretion to the team, through all of these processes, you're an investor that can be a business builder alongside the business for 5 to 10 years. Obviously, that's a reason why that startup founder should be excited about working with a world-class investor in any valuation environment. So I've generally seen a lot more mentions of the ways in which an investment firm can be a business builder alongside a given founder, rather than, for example, starting a conversation with talks about valuation multiples for different types of revenue streams. And in general, I've also seen a lot of references to some of the standard Buffett, Graham Dodd materials that you probably have heard of in the investment world, but might not have taken time to read until you've spent some time realizing that there have been plenty of periods in United States history and European history when the business outlook was very dim, much dimmer than it is now. And in those times, it was important for investors to understand that your timeline as an excellent investor has to be long. Thus, you have to build the relationships and cultivate the founder connections now that can bear fruit when boom markets return.
Excellent, well said. And I think there's a lot of insight there for our audience to pull from. Daniela, any sort of fundamentals that you pull from when times are a little bit tougher, or are there strategies that you think VCs can be utilizing right now, as we said earlier, to set themselves up for success?
Yeah, I mean, I guess I speak for myself because I don't know how other people work, but I think certainly 2021 was a period of almost reactive to a super exciting market with lots of opportunities, and it was a question of how do you prioritize the right one to spend your time on. Now that perhaps people have a little bit more time, you can be more proactive around where to spend your time and think about what is interesting over the course of a 10-year investment period. What are some of the sectors that maybe you can dig into, have a think about, have a prepared mind so that when you do speak to founders in that sector that you're interested in, you sound really smart. Probably not as smart as they are, but smarter than you would have been. And that goes a long way when you can ask the right questions that shows that you've put a bit of effort in as well. And I think there are great companies out there. They haven't gone away just because multiples have gone down a bit. And in 10 years' time, the IPO market will be open again. So we're investing with that time frame in mind and with the potential, and we're still excited about what's out there.
Great. Yeah, I think that's a great point of getting outreach in now and setting yourself up for success in the long run. And I think that that's something that we are, definitely seeing in our customers right now. Obviously, people are looking to grow their networks. We saw a very concentrated effort from this in the US with about a 40% growth in their networks in Q2 of 2022 compared to the first quarter, and Europe having a smaller but still significant focus on growth as well. So, Brian, from your perspective, how has technology and new types of data like relationship intelligence facilitated your team's ability to evaluate opportunities and grow your networks?
I don't think it would be possible to perhaps overstate the importance of some of the technologies that have arisen even in the last 5 years when it comes to improving how an investor can understand his or her relationships and how best to then leverage those to get the connections to the highest quality entrepreneurs possible. And Affinity is certainly in the category of software tools our team uses to understand who exactly is everyone on our team in connection with, and quite simply, what is the simplest path of an introduction to an entrepreneur who, because the entrepreneur probably is running a profitable business, if that entrepreneur is not answering, let's say, any investor emails, there's a possibility that company is doing quite well. And so how do you access the best introduction opportunities? By understanding clearly who each person on your team is connected with, and understanding also that each connection perhaps bears a level of confidence. And so some of the connections that perhaps were trusted as tenuous may be, when you're using a tool like Affinity, more easy to discern in terms of their strength. So I just reflect on how, in the simplest way, by understanding the full email history with the company, you can get a much better sense of what was actually the degree of connection with that company. And if you're trying to understand, is it a partner or a VP or a principal or an associate or an analyst on a team who has the best connection to an individual based on a shared school background or employment background or some extracurricular experience, it's just so fascinating to me, the diversity of strengths and the diversity of origins of connections, and trying to be able to ascertain what was the origin of that connection and what's the strength of that connection right now has been automated by a lot of the software relationship intelligence platforms we've seen. Affinity certainly, in my opinion, well high in the rankings among those. So I would say that in my own experience, the simplest way that we've achieved access to high quality opportunities through relationship intelligence is trying to understand how the most meaningful connections can result in introductions that start conversations that can prove fruitful over time. A lot of that process was manual, even up until 5 to 10 years ago, and a lot of that process is now automated and can be completed at scale by junior members of a team who can then push a process forward for the benefit of the whole firm.
Great, very well said, and glad to hear that you're getting some value out of the platform as well. It'll definitely be interesting to see how VCs continue to grow and mature their tech stacks and use of relationship intelligence to stay competitive in response to market shifts like we're seeing play out right now. So, I want to thank you, Daniela, and you, Brian, so much for your time and your valuable insights today. Before I let you go, do you have any final words of advice for other VCs listening in today? Daniela, I'll go ahead and start with you.
Oh God, the pressure. I come back thinking, it's a long-term game, and that goes for, where you spend your time, how you manage your energy, how you interact with people, and how you think about the opportunities. I think we're in a special position that means that we get to have a 10-year outlook on many things, and that opens up a lot of opportunities.
Well said. And Brian, any final words of advice from your end?
I would certainly add that so much of this discussion has been focused upon how Danielle and I have seen the market and how a lot stays the same and a lot changes, but a lot stays the same either way. And I've just reflected on how I've benefited so much by reading some of the textbook investor literature that has proven timeless. I mean, I was just reflecting on how in this valuation environment, a lot of founders talk about their moats. And Buffett often talked about 5 moats. He talked about economies of scale, network effects, brand recognition, intellectual property, and management teams. And a firm like Team Worthy, we talk a lot about the management team in particular. And so the competitive advantage of a startup over time being the acumen and level of integrity of the team itself is certainly a principle I think most investors can agree upon in the startup world where businesses can pivot between industries quite quickly. And that's of paramount importance. And I think that's enunciated in a particularly forthright way when valuation multiples are causing founders to try to understand how they define their own advantages, if those advantages are going to be constrained by funding and the lack thereof. So I just reflected upon how the competitive moat of a business is always important, perhaps particularly so when constraints like a non-ideal funding environment hamper some of the ability of startups to fund some of their product development, some of their team growth. And so discussing the ways in which some of those timeless principles around competitive moats can continue to encourage founders in this environment, continue to allow them to achieve the billion-dollar businesses that they seek to build, I think is of particular importance as we continue our conversation about how to be the most thoughtful investors making risk-adjusted decisions based on imperfect information.
All right, lots of great insight there, and lots of great insight from you both today. So again, thank you so much for your time, and thank you out there for tuning in today. Please be sure to check out our relationship intelligence report, which goes live on Thursday, the 22nd. Our two-part interview series with Naveen Chadha, MD with the Mayfield Fund and number 5 on Forbes' Midas list for 2022. And make sure you're signed up to attend Campfire, our inaugural Relationship Intelligence Conference coming up on September 26th and 27th, where we'll be exploring what it means to be a part of the leading relationship intelligence ecosystem and how industry-leading deal makers use relationship intelligence technology to fuel growth, manage pipelines, and focus on what matters most as the market evolves beyond 2022. So you can find more on all of this at affinity.co and affinitycampfire.com. Thank you again for joining us, and please take care. Thanks, guys.
Thank you.
Thank you.